Hey, everybody. We're going to get started here in 1 minute. Just wanted to go over some local news. Looks like we've got the port workers are on strike, and I think that's going to affect a couple of industries that are going to be interesting to watch. Interesting to watch those stocks and see how they behave. We can start with kind of following this thread, which is pretty big news, and we got a couple of threads ready to share with you. We'll get into how this is going to affect the uh, whole logistics supply chain right ahead of the holiday. I'm sure the unions really looked at doing this in the ideal time for them, which I can't blame them, right? They're trying to get better benefits for their members and so forth. So we'll see how that sorts itself out. And let me wish you a very good morning. It is Tuesday morning. It's October 1st. October 1st, the first day of the third quarter. And we'll see we'll see how this month plays out. Last month I was a little bit of a naysayer. I was thinking, we may be headed toward a correction in the month of September, but I closed the books on the month of September, and it was a very good month. So um, I feel like for the first full 9 months of the year, it's been a good year. I think it's going to end up being a really good year for my portfolio, and I'll take it. Now I got to figure out how can I make next year, 2025, successful. How can I make a very good appreciation rate, very good return on my portfolio, keep my dividend income, interest income from bonds, continue to grow. It's kind of like a garden I have off to the side of just continuing to create income. And not that I need it today, but at some point I'm going to need that steady income to pay for my living expenses, to send my wife and I on a nice vacation and so forth without ever having to touch one share, not having to sell one share. That'd be cool. So now that September is in the books, let's try to figure out what October is going to be like. All right, looks like we've got a good group already on. Mike, good morning. And looks like you like Usher. And I was talking to my wife. I think Usher is going to be the is he going to be the Super Bowl halftime entertainment this coming year? I think he is. I forgot who it was, but my wife and I couldn't figure that out. Um, looks like Goncalo. Very nice to see you. Haven't seen your name up in the chat, so it's good to have somebody new with us. Shadow Guy, good morning. And I look like an NFL commentator. Yeah, well, I'll take it. Good game last night between the Lions and the Seahawks. It was a high scoring game. It was entertaining and it was fun to watch. So let's talk about the news around the ports, right? So the ports are definitely a vital part of the economy in the US. And we import so many goods, especially from China and other places where they come in through the West Coast ports, the East Coast ports, as well as the Gulf. And it looks like the unions uh, have are playing out a strike on the eastern ports as well as the Gulf ports, and that's just going to cause more demand on the West Coast. And then what I'm thinking is, okay, so the freight's arriving on the West Coast. Somebody needs to have that inventory on the East Coast, is going to have to pay some company to get it across the country. Now, the West Coast is already a big corridor for importing from China. And I live in Los Angeles. We have two major ports here, and we import a lot of goods. And we then put them on rail, and they get distributed to the rest of the country. Definitely that's going to be at full capacity. And it may cause some of the logistics companies to make more money because maybe somebody has a hot product that they just didn't stock enough and they have to get it to the East Coast. Keep in mind, in the US, a greater portion of our population is in the Northeast. That's where more people live and reside. Not a perfect, math equation, but if you look at the country in the US, 2/3 of the population is on the eastern third of the country. So getting all those goods across the country is going to be a big event for the next month. If this strike, continues for weeks, it's going to really cause a bump in companies that are going to be industrial companies, that are going to be integrated freight and logistics. Potentially the shipping companies like Zim are going to benefit because the rates to the West Coast are going to increase. You have fewer vessels, or I should say, the number of vessels needed is going to be much higher. So then the rates from China to the West Coast, from other parts of the world to the West Coast of the US are going to go up. So, so let's take a look at that thread, right? Trying to figure out how am I going to make money in 2025. And I'm going to look at the sector industrials. And within industrials are all these industries: trucking, airlines, marine transportation, consulting services, integrated freight and logistics. Now, we're not going to look at all of them, but I thought we could deep dive into integrated freight and logistics. And one of the reasons is I wanted to look at UPS. So I'm going to do a deeper dive into UPS, FedEx, maybe ZTO, which is a Chinese company, and Expeditors as well. So we'll do a deep dive there, and then we'll look at marine transport, and we'll keep an eye on Zim. So within this sector here, within this industry, these are freight and logistics companies, and we probably all know who UPS is, right? UPS is probably brought a package to your house this week. Very well-known company. And they really flourished. I'm looking at the 5-year chart. They flourished when we were having those supply chain issues a couple years ago. And the revenue, when I get to their financials, is really going to show up the revenue growth, which look great. And then since then, they've had a decline just because it's been hard to sustain that level of revenue, because that was an abnormal situation where you had supply chain issues. Well, we're going to probably have a supply chain, headwind. It's going to be a problem to get logistics done in the US temporarily, depending on how long this strike will last. So UPS is a pretty significant cap company with $116 billion in market cap. They have a PE this year that looks a little bit high for an industrial stock that is not growing very fast. But next year, it's going to get better. Next year being 2025. The dividend rate looks pretty attractive, 4.78. And analysts say, hey, it's discounted a bit and it's a buy. Looking at their revenue, this is what, it was a pandemic induced supply chain shock to the world because China really closed down some of their industries and some of their factories. And that created a shock of supply. And car companies couldn't get car parts to make cars, and it just went on and on. So UPS really flourished in 2020, 2021, and you could see that their revenue has been declining. Let's take a look at the quarterly, which would give us the most recent quarter. Are they getting back on, solid footing? And the answer, I think they're getting there, because they were seeing revenues really go down in the quarterly, but it looks like the worst is behind them, and they're beginning to see their revenue kind of stabilize. Now you get a shock like the one we're seeing, which is, hey, we got a union strike. It's going to cause companies to say, hey, we need UPS to, do more services for us for the next quarter so we can get ready for the holiday season. and Black Friday and the big volume in retail and so forth. So this may turn green in, for sure, fourth quarter, but maybe even as soon as Q3, maybe. So it looks like their business is stabilizing. The stock price has been coming down. It is a very high quality company. This company's been around, I'm going to say like 80 years, very well known company, trusted partner for logistics. So when we look at the balance sheet, let's take a look at the balance sheet. They've got $6.5 billion of cash. And they've got how much debt? Total debt, 26.5. So they've got about 20 billion is their net debt. So 26 billion. Now, what I want to look at is their income statement statistics and see their EBITDA. It's 11.6 billion. So in less than 2 years, they can get rid of all debt. Quality balance sheet. I want debt to EBITDA to be less than 3. Then a company doesn't have too much debt. They can pay it off if they'd like, or they can keep it because maybe they want to do something else with their cash, like grow, acquire a company, become bigger, stronger, buy back shares, make the stock price even more attractive. So all that's good. Solid balance sheet. We studied the business very high level, qualitatively. Okay, makes sense. Now let's take a look at their cash flow to see what kind of cash flow are they producing, or I should say, have they produced, and what would be my forecast of their free cash flow. So you can see that when we had these supply chain constraints, UPS was kind of naming their price. Like, hey, customers, you're going to pay me this amount or I won't move your freight because I've got a lot of other customers that want me to move their freight. So they did really well. So I'm not going to use like a figure around 10 billion. That'd just be too high. But I am willing to say it's going to be 5 billion and probably grow from this point because they really have established that even in bad years, they're doing about 5 billion in free cash flow. And it's a quality company. So I would say I can multiply that times 15 to 20. And the valuation of the company would probably be around 100 billion, just high level. And the company value is 116 billion. So free cash flow is not going to get me there. When we look at the earnings per share, some analysts are very optimistic and think it'll fly back up to $180 a share. On average, they believe it's going to go up to $147 a share. And there is a pessimistic analyst out there, but it's not too bad of a scenario. It'll go down just maybe 15% or so. They're basing their valuation on this earnings per share forecast, which is pretty favorable. You see the growth rate here, and it's a very reasonable PE. So UPS is not overly exciting. It's just okay, but it's not a sensational opportunity. It's just okay. The prospect of this stock doubling over the next 5 years is probably unlikely. You look at their 5-year run rate. You could have doubled if you bought at the right time, and then you could have doubled your investment. But you had to know as soon as the supply chain issues are done, get out of the stock. But from this point forward, if we did see a vibrant economy where there was a lot of demand for UPS, I could see that doubling. But the forecast for GDP growth in the U.S. Next year especially is supposed to drop down to like 1.6%, which is not high growth. It's going to be just stable growth. It could be a little bit better, maybe 2%. The high growth is going to be in China and other parts of the world, emerging markets. So UPS, it has been coming down, but I don't know that it's a total winner in my mind. So let's move on to the next one. Excuse me. So that was UPS, and let's study FedEx now. So FedEx is UPS's rival. They're newer, but they are certainly a good quality company. they have had a different chart, different situation. They did quite well, coming out of COVID, and then they had a big correction. Over the past year, they are up only 3%. Over the last month, they're down. So, what's going on with FedEx? All right. So, when we look at FedEx, it's half the market cap that we just saw in UPS, 66.8 billion. Their PE is lower. Their PE forward PE is much lower. They pay a lower dividend, which is fine. I don't use dividend as the sole reason to buy into a stock. I'd rather see a stock double in value very quickly. So analysts think it's a good stock. It's likely going to be discounted according to them. Let's take a look at their financials. Very similar to the story around UPS. Okay, maybe their downturn started a little earlier, but let's take a look at the quarterly. So they've had one quarter where they had a little bit of growth, and then this quarter is relatively flat. So they've kind of have stabilized, and I could see them beginning to grow soon, because especially if you have this supply chain constraint now with the labor strike, this one is probably going to begin to grow. The revenue is nice and big at 21 billion in the quarter. Annually, $87 billion. So very good. You're paying less than 1 times revenue for the company, and that seems like a good ratio. Balance sheet. Let's make sure these guys have a good balance sheet. 5.9 billion in cash in short-term investments. When we look at their free cash flow, their total debt. So they have 37.7 billion. So what about 32 billion in net debt? When we look at their 32 billion, but we want to look at their EBITDA. So they're like right there at 3, right? 32 billion divided by 10.1 roughly is about 3. So they're right there, barely qualifying. It's kind of like passing a class with a C grade. So this one is okay. Just out of curiosity, I'm going to look at their debt balance and see what's been going on with debt. Have they been accumulating more debt? What's been happening with debt? And I'm looking at the wrong financial. Let me look at the balance sheet. So total debt has really been around the same amount. Interesting. So, okay. So they're okay on the balance sheet. It's not the best balance sheet I look at, but it's okay. It's not a liability. So it's not going to prevent me from looking at this stock further. Now, when we look at cash flow, we saw UPS was at 5 billion cash flow rate, roughly. It could be a little bit better. And these guys have about half the market cap, and they have about half the free cash flow. So you see how investors are using cash flow to value companies. These guys here, it's probably about a $3 billion is a good starting point that I would use, and probably begin to grow up from there. And if I valued this company, I'd probably say I'd be willing to pay $50 to $60 billion in market cap for this company. And again, we're not quite getting to that market cap. And I think both FedEx and UPS, one of the things that makes them attractive to investors is that these are very well recognized brands. People look at UPS and they go, I know what they do. They deliver packages to my house. FedEx, same thing. So it's comfortable for an investor to go in. And that's one of the advantages of having a strong brand. But as an investor, I can appreciate that, but it's not the reason why I would invest. I'd like to see my investment double in value in the next 5 years, and it's just not going to be enough that it's a recognizable company. So cash flow is not going to get us there. Out of curiosity, we'll see. Some investors think, some analysts believe the stock could be valued $350. On average, they think it's $312. And There's a pessimistic analyst at $200. The earnings per share look good, good growth. So it's expected to be very good. And I'm sure it values above that stock price. But I put most of my investing decision making on free cash flows, and both FedEx and UPS are not getting it done. So I move on. Let's take a look at ZTO Express. And ZTO Express provides express delivery value-added logistics services in the People's Republic of China. Okay. Well, let's look at the 30-day chart. Whoa, 16%. Very nice. 5 years. It's been sold off. Chinese stocks have been sold off. I think it was somewhat irrational. But let's see where these guys value. So we just saw two American companies, UPS, $5 billion of free cash flow, FedEx, about $3 billion of cash flow. Good balance sheets. UPS had a better balance sheet than FedEx. And both of those companies were not growing. They're probably expected to grow modestly going forward. So when we look at this guy, it's almost $20 billion in revenue, which is quite a bit lower than both of the American companies. The PE ratio is comparable. So it's not like a super low PE. And they do pay a dividend, which is interesting. It's a strong buy with 9%. Now, China is going to be growing at 5%. So that is an advantage that if you're operating in China, you're probably going to be growing faster. And in fact, these guys have been growing no matter what. They grew. Impressive. Okay. So they didn't go into the negative. They slowed down, but they didn't go to the negative. Impressive. Cash and cash equivalents, 20, and this is in the Chinese yuan. So it's 0.14 is the rate here. Doing it in my head, it's about 3 billion in USD. So about 3 billion in cash. Let's take a look at their debt level. And it's lower debt than cash. They can pay off debt immediately. They can write a big giant check. It probably wouldn't be enough room for all the zeros, but they can pay off the debt. So it looks good. They have less than $3 billion of debt. Okay, so balance sheet looks good. Cash flow. So we've got a company that is growing, and their cash flow is 7.6. This is a good year. Now, it is good to see that it's rising. You see that we're going from 1.6 billion yuan. They had negative cash. They could be growing, adding stuff to their operation, repairing things. And then they got on this nice upward trend. So let's call it that they're at about a $7 billion yuan company. So when I do that in my head, I get to about 1 billion of free cash flow. And when I look at this company located in China, it is growing. I'd probably get to a valuation of 15 to $20 billion. And their value, and this is in USD, is about 20 billion. So this one's fairly priced. I'm not overly excited about this particular company. So it looks like logistics it's not floating my boat. I'm seeing a big causal factor of supply chain shrinking, but it's not enough. It's not like, wow, this is just a great opportunity. I could see this stock really rallying 50% next year. I'm not seeing that. One more, and then we'll call it a day. I did not look at this prior to the live stream. I thought it'd be interesting just to take a very organic thread. There's a big piece of news. Let's see where this takes us and kind of see, is there a good investing opportunity? So this is our Expeditors International of Washington. And what they do, they provide logistics services worldwide. The company offers air freight services such as air consolidation and forwarding, ocean and ocean services. Okay. All right. We know what they do. Pretty good market cap, $18.5 billion market cap. They do about $9 billion in revenue. So you're paying 2 times revenue for the company. PE is a little high, 28. Forward PE 25.7. Analysts say it's just a hold. It's overpriced by a bit. And you can see the stocks really worked. They are working. Nice upward chart. Looks good. Look at their revenue. Holy smokes. What's going on here? That's big revenue loss. So you can see here's where the supply chain issues that plagued the US and I think the world really showing up, that a lot of air freight was needed and a lot of services from this company were needed. But this is a little concerning. Let's look at the quarterly. Well, the quarterly is beginning to grow. That's very encouraging that they're beginning to grow. Pretty nice clip too, almost 9%. Okay. So hopefully the balance sheet looks great because they made all that money. They paid off all their debt, I imagine. So cash and short-term investments, 1.27 billion. And total debt is less than that. So they can pay off debt immediately. So balance sheet looks good. Cash flow. So free cash flow. I'm looking at the quarterly. So let me get out of the quarterly. And free cash flow. So cash flow has gone down. You can see that they peaked in 2022 where they make the most cash flow. They're beginning to grow. So I would expect that 695 is a pretty good number. Maybe I could use 800 million or a billion of a basis for my cash forecast. And this company, in my mind, is worth 15 to 20 billion or so. If I multiply that 1 billion times 20. So they're fairly priced. So these companies are being fairly priced. It's not overly attractive to me. I think there's other industries that I would be more excited about. So we'll close that one out and just kind of say, okay, well, supply chain issues are causing, the economy to take notice, but I'm not seeing great investments in those companies we just saw. Shipping is a different animal, and I think shipping rates will go up because this is one more problem that these companies are faced with, and the shipping rates are going to go up. I was in Zim, and Zim was just a winner over the last year, 145%. It's a different story, but still positive over the 5-year. Look at this, man. I love seeing companies that are irrationally sold off, and then they come back and really reward investors that did their homework. So this company has been flying up. And congratulations to all the Zim stockholders. And I've got a lot of, I interact with a lot of them on Reddit. And I sold out. About here. And all my amigos are still in it. Congratulations. Keep making all that money. And I sold out here. Nobody needs to shed a tear for me. I made plenty of money on that investment. And I'm glad to see that all the people that are in Zim are making more money. And I think Zim can continue to work. Tension and problems. Whoa, what happened here? The market opened and it went down 6%. That's weird. If shipping rates are supposed to go up, wouldn't Zim and other shipping companies, benefit? I would think so. This might be a good list to kind of take a look at and see, what are these stocks doing? Are they going to really benefit? It's known that, hey, the market had shipping rates wrong 2 years ago when they sold off Zim and said, oh, shipping rates are going to go down to zero. Nobody's ever going to pay any money for shipping. Well, that was completely wrong. And companies really benefited. This one here is up 46%, Kirby Corporation. And this is tank barges. So this is kind of a different animal. So they transport liquids. And this is based on the chemical industry and probably the petro industry. So this is a different animal than Zim. Zim does containers with product from China to the US and so forth. So So that might be a pretty neat little exercise that you guys could take on. Kind of look at shipping companies. This might be a source of short-term returns. I'm just one investor, but I'm going to voice my opinion how I see it is. I got out of Zim because first I made a good return and I'm out of the stock, so I'm good. All right, so followed that thread, and I think we're good there. Okay, so let me catch up on some comments here. So we've got Shadow Guy. Hello again. Ron Kin. Very good to see you. Thanks for joining. And then Mike, Dividend Investor Guy. Kendrick Lamar. Okay, I confused him, but that's cool. That's still going to be a good halftime show. The halftime show for the Super Bowl would be Kendrick Lamar. All right. Anderson K.HT show is so necessary. I'm not following. I'm sorry. K.HT show is so necessary. I don't follow. If you can give me a little more, I'd appreciate it. Hey, Tomas, good morning. How are you? Very good to see you. Trader Prad, good morning. Enjoyed your live stream last night. Hopefully you get some volatility so you can make some money today. Good luck. And then Hawker, booyah. Good morning. All right, so we went over that thread of logistics. There was one earnings. Oh, Kendrick Lamar. Okay, cool. I appreciate that, Trader Prad. I guess I study stocks way too much, and I don't know what's going on with, who's popular, nicknames and all that. So, all right. Thanks for the education. Now I know what the term is. Appreciate it. All right. So companies that are announcing their earnings today, Paychex announced their earnings already. So we'll take a look at their stock, see what it's doing. It looks like McCormick and Company, which they do spices and flavors and all kinds of stuff. They announced. It might be interesting to take a look at. Both are, interesting valuations. Then Nike, after the market close. And I'm going to do a live stream today after the market closes. I'm going to do my live stream at 5 p.m. Eastern. And Nike is going to be a centerpiece to that live stream. I'm a Nike investor. I've been playing the recovery of Nike, and we'll go through a full evaluation of Nike post their earnings. It'll give me time to dive into their earnings release and update my whole analysis. But for now, let's talk about Paychex. So Paychex, I think their name kind of gives us a understanding. They're in the human capital management, HR services, predominantly payroll. So companies need to pay their employees, and they also need to provide benefits and provide kind of the collection of pay, compensation, and benefits to employees. And that's what these guys do. It tends to be a very stable company because companies continue to have employees, they continue to pay them, and they pay Paychex for the service to take care of their employees. Looks like the market's not fully in love with their earnings, but let me check something really quick to make sure that I have it in context. Looks like the market's selling off a bit. First day of October, we're not off on the right. It's kind of like when you start a baseball game, you're down 2 runs in the first inning. All right, we can come back. We can come back. So Dow Jones is down 0.5. It's kind of eerie how they're all down about the same amount. Whew, I don't like seeing that kind of combination. Russell is up. Go small caps. All right. Like seeing small caps do well. VIX is up a little bit. All right. Hopefully this opens up some opportunities for my trader friends to make some money today. All right. So let's take a peek at Asia because I'm hooked on Asia. Nikkei, which is Japan, is up almost 2%, was up almost 2%. They're way ahead of where I'm at. So they've already closed their market and they booked a 2% gain. China is not going to be open for like 5 trading days. They have a number of holidays that are being celebrated starting October 1 through October 7th. So it's going to be interesting to see. This stock exchange is going to be closed, but we have some of their stocks traded in the New York Stock Exchange. So they're open to be traded like Alibaba. So I'm going to take a look at Tencent and Li Auto and in this stream, and we'll see if they're being traded and how their prices are going up or down. So that's the context of the stock market. So now back to paychecks. It's down just 0.8 now. Okay. Well, that's not like bucking the trend of the stock market. So it's not like stock markets going way up, paychecks is down, which gives me a different sentiment level. Okay. So this company has a $48 billion market cap and the revenue is 5.8 billion. And we just saw some industrial stocks where the revenue was much higher in proportion to their market cap. Why is that? Well, investors really like consistency of revenue, consistency of profit, consistency of free cash flow. So when we look at paychecks, I expect we're going to see that consistency. Software companies tend to have high valuations because they deliver that consistency. They're high free cash flow generating. They have very good profit margins. Paychecks is not a pure play software company. They provide a service and they do have a lot of software to their service, but they're not a pure play software company. I know that because that's the industry that I've worked in for a long time. PE is 28, not terrible. 27 going forward, not terrible, but not overly exciting either. Okay, so analysts say it's a hold and it's priced a little too high. When we look at the 5-year chart, the stock has worked. It's worked, if you look at 64% return, you add the dividends, I think investors would be satisfied. They're not writing home, saying, man, I invested in this stock and tripled my money in 5 years. But they're probably like, okay, it's not a dog stock. It's okay. The 1 year, it's working. You go 16.21 plus almost 3, you're up to 19% return. I don't know that you're going to get a lot of complaints around that. So when we look at their revenue, see consistency. That's why Paychex, even though they're not a giant company, has a decent valuation, is that consistency growth. Looks pretty good to me. When we look at their balance sheet, cash flow 1.5. Paychex is not, they don't have to build giant factories and put tons of capital into those factories. No, they use their heads for a lot of their revenue and they have to buy systems, but everything's outsourced these days into, public cloud. So they probably don't need a ton of capital. So when we look at, they have cash of 1.5 billion and debt is less than that. So they can pay off debt immediately. So clean balance sheet, quality balance sheet. A lot of software companies and services companies like these, that tends to be the case. That's why Microsoft's worth so damn much. Is Microsoft doesn't have to build a factory to supply the demand on their software products. They just keep stamping them out. They don't even have to print CDs anymore. People download the software and it comes pre-installed on their computers that they buy from Dell or HP or whomever. So cash flow, that's where the money's at. Free cash flow. Remember that term, consistency. That's what we want to see, because when you're doing a forecast and the company shows you that they're going up and to the right smoothly, confidence. You feel like, okay, I can follow that graph and say this is going to be a $2 billion free cash flow company because they've been consistently growing roughly, 10% or so. So that's why these guys get a good valuation and it's a good, consistent company. If I valued the company, I'd probably get to 40 to 60 billion dollars of value, and they are right there. Now, I have other software investments that I'm currently stockholder in that I believe looks better than this. And there's one thing that I dislike about Paychex that I like, that other alternatives that I have, like Adobe, DocuSign, Zoom, is Paychex is a services company. Okay. And there's more competition in services. Like their big competitors, ADP, and there's Ceridian. So these companies, it's hard to switch over. Like a company just doesn't switch their payroll provider every other week. They might switch every 10 years. It just doesn't happen all that often. But it does happen, especially if they're unhappy with the cost, they're unhappy with the service. So Paychex is constantly guarding against being replaced. Software companies, for example, DocuSign, they create their code and it's all over the world and it's being used. And the more revenue that comes in, the more profit they make. They don't have to do anything. They don't have to deliver paychecks to the recipients that these companies need the pay to go to. So I think Paychex is a decent investment, but not the right investment for me because I get to pick from thousands of choices, and I happen to like pure play software companies better than Paychex. And they're not giving me a huge opportunity here. Could I continue to make that 15% a year? Potentially, but maybe not. Maybe it drops down to 10 or 5% return per year. So it's not worth I think my capital to put it into Paychex. I'd rather keep it in Adobe. I'm into a couple of different software companies that I think are going to pay off. So that is Paychex. They announced their earnings, and looks like the stock's down a little bit. The market is selling off a little bit. This sell-off is somewhat expected, right? We just had a very good September. It's the final day of the third quarter. So a lot of these big investors, ETF, hedge fund managers, they're like, okay, we locked in a very good quarter. Our investors are going to pat us in the back and say, good job, man. You did a great job. But now we want to rebalance. We want to offload some stocks. Boom, they're selling them off a bit. It's not a huge sell-off. It's just a modest sell-off. When we look at, let's take a look at sectors. So sectors, looks like most sectors are in the red, except for communication services. Okay, so we'll see who's doing well in the green there, but that's the sector that the most valuable company is Google Alphabet. The second most valuable company is Meta, and then Netflix is in there. I think Disney's in there. A bunch of a bunch of other companies that are communication services, including like AT&T, Verizon, and so forth. So that particular sector is holding up okay today. Materials is holding its own. Energy holding its own. Okay, but the worst performers, technology, and nobody's going to shed a tear for that sector because they've made too much money. They made too much money. They got to give some of that money back. But that's what's going on. All right. So I've got a couple more stocks to go, but let me check the chat here. Trader Pratt, spooky season is here. All right. October, man. Well, I'm done predicting stuff, guys. So at the beginning of September, I was a fraidy cat, and I'm like, oh man, I think we're gonna have a pretty good pullback. Stock market's expensive. I still think the stock market's expensive. I think that the election is gonna kind of put people into overload. Like, oh man, it's just too intense. The political news tends to be a burden. And somehow we got through September. I closed the books on my portfolio and I'm like, holy smokes, man. Market just, surprised me. I wanted to say taught me a lesson, but I usually feel that way when I lose money. Now, when I make a bunch of money and it's a little bit of a surprise, I'm like, thank you, stock market. Appreciate it. bank it, move on. So I'm not going to make any comments on my prediction for October. I'm going to try not to, I'll try not to, but here we are, October 1. Let's see how it goes. Shadow Guy, bond yields seem down a lot today, and Goog is up, interestingly. So bond yields have been dropping. Bond yields had been rallying, especially last week. And I was buying into that because when yields go up, that means the price of the bond's going down. When yields go down, bond values are going up. So that is interesting. Now, that's following the direction that the Federal Reserve, as well as the Chinese, whatever they call their Federal Reserve, Europe, everybody's dropping rates. So now the bond market's following that type of direction. I think yields will continue to go down. So locking in some longer term rates is a good idea, especially for us older guys that are like, you know what? I got some years where I made some big dollars on stocks, big dollars on real estate, or maybe you started a business, you made big dollars, and you're like, I only have to build my wealth once. I don't want to rebuild it again by betting everything on, I'm going to bet everything on, GameStop, and, it was up, $10 million, and now I'm down and I only have 100 grand. That's not the investing that I do, and not anywhere near. I was using an extreme, but maybe we lock in some of that capital into a income portfolio that's just a steady eddy, generating some income, just putting it off to the side. I don't have to think about it much. And bonds, if you lock in some long-term rates, now may be a pretty good time because they're going to be a full 1% lower in a year, maybe a full 2% lower in 2 years, which means your yield in 2 years is going to be 2% lower. The environment's going to be different. So just a food for thought. I've made videos on my bond ladder. I made videos on bonds. Check them out if you're interested. And Shadow Guy brought up Google. So he buys Google. I buy Goog. Tomato. We're saying the same thing. It's the same company. I forget why I bought Goog and what the difference is between Goog and Google, but that's the one that I'm in. So it's up a little bit. That's good. This stock has been, in my mind, underappreciated. Now, it's gone up nicely over the last year. It's gone up very nicely over the last 5 years. So, but if you look at their Mag 7 counterparts, and I'm not going to use NVIDIA because it's a very different company. I'm going to use Microsoft, which is a very similar company. The number one competitor of Microsoft is Google, and these two companies are very comparable. So when we look at Microsoft, man, they follow each other pretty closely, huh? Maybe that was a bad example because it's not showing a big difference. All right, so how could I break this deadlock here? Those two companies are very similar. I didn't know if they meant it, but they're very similar. But let's put in, just to spice things up, and I'm not going to put Apple because that's a hardware company. I'm going to put in Meta just to break the tie because I know Meta is going to break the tie and show. So Meta got sold off more severely, and the recovery has created such a better return. So Meta has had a better return than the other two. Sorry, I can't count this morning. So, but they've all been good winners over the last year. Yeah, Meta's kind of taken off on these guys. And that's what I mean is, if you look at their performance for the last year, Alphabet has been less appreciated than the other two. But I believe strategically, Google Alphabet might be the most powerful corporation operating on Earth right now. They are so strategically well positioned for AI. They're well positioned with search. That's a money print. I know the federal government in the US prints money. Google prints a lot of money, similar to them. I don't know who prints more money, but They just print money from their search business. YouTube, case in point, you guys are watching me on YouTube, number one streaming platform on earth. And they don't have to pay content creators. Netflix, on the other hand, awesome company. But if you look at how much they have to pay to develop content, it's humongous. Huge advantage, YouTube. YouTube doesn't have to put all that money into content. Their creators do. And even the big media companies have to come to YouTube because YouTube is becoming kind of like the television station to the world, where no matter who the content creator is, they have to end up on YouTube to be relevant. So search for Alphabet is phenomenal. YouTube is phenomenal. The cloud business, which is they provide public cloud services, also referred to as being a hyperscaler, is growing faster than their two rivals, AWS by Amazon, Azure from Microsoft. So they're growing faster in that space. And last, I could go on for a little while, but their robo-taxi is real. There's cars driving themselves and putting passengers in the back already in like 6 cities. And they're beginning to form partnerships with Uber and other companies where the Google, style is create awesome technology that is going to be super profitable and then let other people develop on it. Android operating system. It's the most used smartphone operating system ahead of Apple's AI OS. And they did that because they created the operating system and then said, hey, Samsung, you want to adopt this? You can make the awesome devices you do. Huawei, all these other non-Apple device manufacturers, they develop on Android. Bingo. Google is sitting there pretty. They don't have to manufacture any devices to continue to be the dominant leader in operating systems for smartphones. So as I look at Google Alphabet, it is, again, one of the most powerful companies, if not the most powerful company operating on Earth. And they're so strategically strong that I continue to buy shares in Google. Every pullback, I've been buying shares. I probably have invested more money into Google than any other stock. The returns aren't as good as other stocks, but that's how I feel about the company. Let's take a peek at how much money I've put into Google. So I put $115,000 of my hard-earned money into Google, and I will put another $100,000 into Google. I think the company is going to be worth a lot more in 5 years, a lot more in 10 years. That's one, in my mind, that's one of my most surest kind of expectations. They just have, you're playing poker against somebody who always has 3 aces. They're going to win a lot of hands. They're just going to be really, really strong. Now, the return hasn't been there, but in a way, and I think my friend Mike is going to appreciate this, that's an opportunity to buy more shares. It's been harder to buy into Meta because, geez, man, the freaking stock goes up too fast. More lately, like Baba, right? It's hard to buy into Baba. I already own Baba, but it's hard to buy more shares because the darn stock's going up so fast. So that is my story on Google. Thanks for bringing it up, Shadow Guy. And sorry if I went too long on that, guys. And hopefully you found it interesting. All right. So Tomas, what about Berkshire? Ton of respect for Berkshire. I just don't own the stock. I study Warren Buffett, not as much as, like, I study other investors a little more than Warren Buffett. Warren Buffett is an awesome example, and I love his philosophy. And, I'll continue to appreciate that. But I just don't buy that stock. I think it's a great stock for those investors. I think it eclipsed $1 trillion in valuation. You're buying an ETF / hedge fund / mutual fund. I think my biggest concern with Berkshire is Warren Buffett is a national treasure, but he's in his 90s. And what's going to happen? They lost Charlie Munger, a brilliant mind. Just, oh man. Study the super investors just to understand what you could potentially do. Okay. If you're younger out there and you're 20 years old, 25 years old, 30 years old, 35, 40. It's inspiring to read Charlie Munger's life story. Super inspiring. Just to tell you really quick, since we're talking about Berkshire, Charlie Munger graduated from Caltech as a meteorologist, the dude that tells you the weather. Hey, it's going to rain. And he realized I'm not going to make any money in that. So he went and got a law degree, became a successful attorney, became a partner at a firm, was making plenty of money, was stock investing on the side, was good at it, met Warren Buffett. They partnered and really started to collaborate quite well. He traded in a very successful career in law and did a career change, I think in his late 30s, early 40s. He lived till he was 99. Man, Charlie Munger, the man, the legend. And his moves were brilliant. He bought into Costco early. He made a ton of money on Costco. And Warren Buffett has brilliant moves as well. And both of them are, let's get really wealthy over a long course of time. Now, the inspiration for all of us is, use that as a North Star. You can probably make more money than you can imagine. You can probably, a little bit of goal setting it's inspiring, yes, but it's also, it limits you. You're like, well, I want to save up $5 million. That's my goal. Okay. But hell, why not 50? Why not more? Right. And Charlie Munger and Warren Buffett are examples of, man, they made billions for themselves. And so I would encourage you to study Charlie Munger and Warren Buffett. I draw a lot of inspiration from them, but I don't own the stock. Specifically, more modern investors. I have a list of investors that I follow. Probably the one that I started following, and I'm trying to search his name because I heard something interesting from Jay Pulaski today. I think his investing moves currently align with how I see the world and how I'm investing. So that's interesting. So I'm kind of a free agent, a free safety, going from investor to kind of see what's working and what's going to work in 2025 and 2026. So that's my story, Tomas, on Berkshire. I'm going too long on topics. I hope I'm not boring you guys, but let's keep rolling. Hawker Baba keeps holding up well. Let's take a peek. Let's take a peek at Baba. Alibaba. Boom. 2.2%. Now, I was crying a minute ago of how hard it is to buy into Baba. It never goes down. It hasn't gone down for about 2 weeks. So let's keep rocking, Baba. I own the stock. Let's keep rocking. I'm probably going to buy shares today. I think that the Chinese trade is going to work. And there's just too much data that tells me the Chinese market's going to double in value. There's just too much. I could be wrong. I will gladly admit if I'm wrong. But the data doesn't lie. You look at these valuations. You look at forward PE. This is a growing, powerful company. Comments similar to the ones I made about Google. Alibaba. Biggest economy in the world is the US. The one that's going to be the biggest is going to be China. There's just the math. They're growing faster. They got more people. They're going to be the biggest at some point. And these guys are in China and they're coming to the US. And you can buy things on Alibaba and get them direct from suppliers in China. Super interesting. But the rest of the world, Alibaba's it's like a giant octopus and they're getting their tentacles all over the world. So Alibaba I'm big on. I'm glad I hung in there, man. It was getting a little bit like, what the heck, man? Why is this stock just beat up? It's like whipped like a rented mule. Just there's irrational exuberance on the way up and irrational pessimism on the way down. It's just irrational. It's like, guys, man, this it's not like this company's dropping revenue. They're continuing to grow. What the heck's wrong? Is there something wrong with me? No. Just the investors need to catch up. All right. So BABA is working. What do I think about the VIX? I think October. Well, there I go again, making predictions. We'll see where the VIX goes in October. I wouldn't be surprised if we see volatility. All right. I'm learning. Falls Gray, what's up, man? Good to see you. Can I look at Planet Fitness? They raised prices this year, first time like in 30 years. Might be good for earnings. Let's take a look. Planet Fitness. Planet Fitness. I would say that, I looked into becoming a member. I have a home gym, and before I did so, I was like, okay, home gym membership. I went with home gym. And I was really surprised how affordable it is to become a member of Planet Fitness. I was like, that's like nothing. So I could see how people are become members of their program because it's so affordable. All right, so let's take a look. We got a $7 billion company, nice and small. All right. PE ratio is a little high, and forward PE is 31. Okay. Analysts think it's fairly priced and it's a buy. They're going to announce their earnings on November 5th. And when we look at their revenue, nice growth, very nice. Okay, good. It's a $1 billion revenue company, trailing 12 months. Okay. And when we look at balance sheet, that is going to be an item that is really important, because if they had to take on a bunch of debt due to COVID, that might show up. So $350 million of cash and short-term investments. Total debt, $2.6 billion. So net debt about $2.3 billion. So when we look at their income statement, is 4.6. So 2.3 divided by, so they have a lot of debt to EBITDA ratio. So let me make sure I did that right. So we got EBITDA of 460 million. And we had balance sheet. So we have 350 million in cash, and we have total debt of 2.6. So we're at like 2.3 billion in debt. So we're looking at like 5 times EBITDA, 5 years to pay off debt. Now let's follow the trail of debt. So we were dealing with COVID. They were dealing with COVID. And the amount of debt they took on isn't that much. I mean, if you look at COVID, just really hurt their business. But the debt didn't really go up. Good job. Good job, Planet Fitness. But still, it's an uncomfortable situation when you have basically it would take 5 years to pay off your debt. It'd be nice for that to be less than 3. So that's one factor that would probably cause me to not invest. I'm like, okay, that's too much debt. But let's take a look at cash. So free cash flow has been growing, and it's up to 185. So just rounding up, because they are growing, I'm going to use 200. They're growing their business, so I'm going to multiply times 15, maybe 20. Gives them a valuation of 3 to 4 billion, and they are trading at 7 billion. Oof. The stock's really moved up. I mean, over the past year, it's gone up nicely. So this one here doesn't look good to me. I don't like the balance sheet. They have too much debt in proportion to how much EBITDA they produce. And it's a lot like, if you're running your own household budget, right? You don't want to carry too much debt. If your mortgage payment is 80% of your income, it gets really tight. You're like, oh man, I only got 20% of my income to live on, to pay for my car, my food, and everything. Having too much debt has the same, force on a company. It makes it very tight. They can't grow as much. If a competitor arrives into the market that has no debt and can grow faster in the right markets where it's most prosperous, it might put Planet Fitness in a really bad spot. The valuation. So businesses that people can get their heads around tend to be Coca-Cola. It seems like everybody's in Coca-Cola. Planet Fitness, obviously people are like, oh, I like going to Planet Fitness. I enjoy the experience. I'm comfortable buying the stock because I know what I'm buying. Okay, I'm not going to argue with that. People are going to invest the way they invest. I invest based on what types of businesses are going to drive the most value to investors, like Google, Alphabet, Meta, Microsoft, right? And Planet Fitness is not driving enough cash flow to substantiate that valuation to me. Their balance sheet is not healthy enough. So I am a pass on Planet Fitness. I think there's thousands of stocks to pick from. I could probably find something that is going to perform better for me. I think a lot of the gains in the stock are already priced in. So that's my opinion on it. Good luck with that stock. And let me know if you need anything else on Planet Fitness or anything else. Good to see you, Falls Grave. And FYI, I checked out your YouTube channel, and it's pretty cool, the arrowheads you find. Pretty damn cool. Don't you think Meta will have a correction soon? So could be. But you know what I'm going to do if Meta goes down is I'm going to buy, and I'm going to keep buying. So the things that I look at structurally for Meta and just about any company, I'm going to use Uber as a different example. I'm going to use Uber as the example and then come back to Meta because I think I can kind of make my point and then come back to Meta. So I really believe in the Uber business. I think that Uber has a network that is unrivaled. Ride sharing, dominant. They're doing food delivery. They have competition there. They haven't quite become dominant there, right? DoorDash is doing a good job. Postmates is in there. But their network for ride sharing, growing, powerful. International growth is going to be really good. So structurally, from a qualitative perspective, I love Uber. I love their position. I could see them being twice as big in 5 years, easily. I could see them having the platform and the network to launch new businesses like Robotaxi, continuing the delivery of food as well as other items and products. Logistics could be a growth engine for them. So the story of Uber qualitatively is intact. Love the stock. The problem, if you want to call it a problem, is the stock has performed well, so it becomes expensive. Now, I'm not buying more shares of Uber right now, but I could tell you if Uber dropped by 10%, I'd be buying more shares of Uber. Right now, I'm holding. I've got how many shares of Uber? Uber is an industrial stock, by the way. It's funny, but that's where they're classified. I have $78,000 at Uber. Okay, I'm good. I'm waiting for their earnings, get some more data, and then make a decision because I think their stock is fairly priced. I think it's discounted by 11%. So, okay, I'm going to hold on Uber. I'm going to hold on Uber a little bit. And coming back to Meta, everything I said about Uber is kind of same story on Meta. So you look at their business high level. Are their social apps becoming more popular, less popular? More popular. They're kind of taking over the X business, which was Twitter. Thank you, Elon Musk, for being kind of a loose cannon. It opened up the door. Now Meta's got one more product that is growing and doing really well. Yay. Okay. Their AI business is exciting to me. It's the number one AI app that I like to use. I try to do a lot of heavy investing analysis, and their AI is impressive. So they have over 3 billion people logging into one of their apps on a monthly basis. They can launch AI as good or better than anybody on earth because they've already offered it to me, my wife, and we've started to use Meta AI. Very easy. It's free. So try to compete with that GPT, Chat GPT. Try to compete with that Microsoft Copilot. Meta's going to provide it for free. Why? Because they have more money than they know what to do with. And that could be the next pillar of users that Meta grows into. So the qualitative story on Meta is intact. Yes, the stock is expensive. If it pulls back, thank you, stock market. I would like to buy more Meta. Right now, I think I'm holding on Meta, but I have bought shares recently. I bought shares in September. If you have any type of pullback, I'm going to be a buyer because Meta's story is so freaking exciting to me. So that's my story there, Tomas. So if it does have a correction, I'm going to be unloading. I could drop 10 grand on Meta in a week. Right now, I'm putting a lot of capital into Amazon. Let me show you where. And Amazon's kind of in a similar category. I'm excited about the Amazon business. I sold the stock and then I regretted it. Oh, man. Don't regret things in life. Well, I haven't learned that lesson, I guess. So I went from $0 to $30,000 of Amazon over a month or a little more time than that. I've got 2 puts out there. I'll buy 200 shares of Amazon if it drops to $185 a share. Where's the stock trading at? 100. So it looks like I'm in the money there. So I'm going to be loading up on Amazon. There's only in my mind, there's certain companies that are kind of I would say I have a high expectation that they're going to continue to be leaders. Meta, Google Alphabet, Microsoft, to some extent Apple, but I do think they're overpriced. But like Uber, I believe Robinhood and financial services, I think they're a thought leader and they continue to come out with products that their customer base loves. So it's companies like that I'm overly excited. There's no rival to Amazon, none. And they will be a leader in 5 years. They'll be a leader in 10 years. It's exciting to think about what are they going to be in 10 years? Holy smokes, man. If they're this successful today, and like one bit of information on Amazon is their video business, right? Their streaming is now running ads. And I believe their run rate of revenue on ads, which is pure profit, $3 billion. It's like Amazon, dudes, you keep making money like ways that I didn't think you were going to figure out. And there you are. You know, you're the number one e-commerce platform in the history of mankind. So you have such power and dominance there. You have a public cloud business that is number one, hugely profitable. It's AWS. You have this streaming business that's doing really well. And you can go on and on about Amazon. So I'm loading up on Amazon. All right, so let's keep rolling. So, all right, good to see your comment, Mike, on DCA. Okay, have you looked at Qualcomm? I own Qualcomm, and I have looked at it lately. I did buy some shares yesterday. Oh my God, what's going on, Mike? What is going on with Qualcomm? Now, I have to tell you that the news that they might acquire Intel was actually bad news for me, and investors felt the same way. I think the stock dropped 3%. I'm like, okay, the big picture's changed for Qualcomm. I don't know that I like them buying, all the assets of Intel and merging. Intel is a giant bag of problems, it seems, and the story just cannot catch a break. So on these guys here, I'm going to look at this because this could be an opportunity. This could be an opportunity to buy some more shares, but I still have that lingering. What the heck are you doing trying to buy Intel? I really like Qualcomm. I like their business. I think the Snapdragon chip is great. It's like, why do you have to ruin a good story, Qualcomm? But for all I know, they're 100 times smarter than I am. They probably see an opportunity there. So this is an opportunity for me. I'm going to note it and probably end up buying some shares. But I think of the semiconductor stocks, this one is discounted in my opinion. So I'm going to be buying shares. So thanks for bringing that up, Mike. I think you and I invest very similarly. All right. So thanks for showing up, Falls Guy. All right. So Shadow Guys decided to start buying into NMFC. All right. What is NMFC? New Mountain Finance Corporation. Down a little bit. Okay. So New Mountain Finance Corporation, a business development company, is a private equity buyouts loan fund specializes in direct investing and lending in mid-market companies, defensive growth industries. Okay, interesting. They pay a nice dividend. They're down for the 1 year. So the thought that comes into my head is, as you see interest rates go down, especially if they go down like they were around 2020, it's literally free money. It's like companies like these guys have access to, capital at very low interest rates. So it makes their operating costs lower, more profitable. That's one of the thoughts that I have around this business. 1.3 billion revenue, 372. And this is probably all going to be earnings from the businesses they own. So when we look at their financials, you have other revenue. They have been growing. Looks good. Free cash flow looks good. This is interesting. I'd have to get comfortable with what are they investing in, and they would probably tell us on their website. So defensive income-oriented growth. So when you hear middle market, that means small mid cap stocks, okay? And they're providing capital loans to these small mid cap companies. Okay. Probably having a pretty good spread. I'm going to lend them money at 8%, and I'm going to borrow it at 3 to 4%, and that spread is profit. So, I'm liking what I'm seeing. I think small and mid-sized companies have been underappreciated. The Magnificent Seven, the big caps have taken a lot of capital, a lot of attention. These big ideas, AI has taken a lot of attention. Now it's taking a lot of attention is China, the China trade. So I think there's a lot of opportunity in this mid-market space. And maybe companies, instead of going public, because they're like, you haven't seen a lot of IPOs, by the way. If you noticed over the last couple of years, IPOs are kind of scarce. Maybe companies are staying private and saying, let's just borrow money from New Mountain Finance. They'll lend us the money at this rate of return. Everybody wins. That company can keep growing. This New Mountain Finance gets to make money. They get to grow. And it's a very organic growth. It could be that case. I want to take a closer look at this and see what it's all about. Let's take a look at their 10Q. Now this one, hopefully this is visible to you guys. I don't know. Let me try a different way. I don't think this is going to show up nicely. All right, I can make this bigger. All right, so I'm going to look at their balance sheet. A company like this is going to be, I think the balance sheet could tell me a lot about the company. Where are they lending money? What kind of investments do they have? Okay, so they've lent money to funded debt investments, Paw Midco, AAH. So these are the business they're lending out, and they have the industry that they play in. This is a consumer services company, business services, software. You can see the interest rate that they're earning there. Okay. So they're investing in companies in the software space, healthcare, financial services, business services. This looks pretty good. Looks interesting. It's a very different, unique investment that I think is worth considering. So this is good stuff. I'm gonna take this one as my homework and take a close look at it. New Mexico. I think there's a lot there. I think the story, I like the story of what they're doing. They're really going after that mid-market. It's been unappreciated. It's probably a very good situation for a company like this because the public markets are not helping small caps right now. So instead, hey, well, let's just go get some financing so we can keep growing, and we don't have to IPO right now. We can partner with New Mountain Finance and kind of get to that growth we want. So that story I like. How is this stock going to perform? I mean, the 5-year doesn't look great. The 1 year, okay, that I'm going to have to understand better. What's going to be the rate of return? I mean, at 8% dividend, I mean, you broke even for the last year. So that's not great. So is it going to appreciate? It didn't appreciate over the 5-year. Okay. So I'll get my head around it. It may not qualify into my portfolio because I don't see enough upside, but you got me thinking, if not New Mountain Finance, maybe one of their peer companies. I could take a look at that and maybe see if it's something that has organic value to it that is going to appreciate and be worth a lot more in 5 years. All right. So good one. Way to think outside the box. So Qualcomm almost hit my target price. You drive a hard bargain, Mike, but I like your style. One more dollar in your end. Cool. Nice bond, 6.2. Yep. All right. And then Bobby Jane. Okay, so this one is interesting because you said India. I was talking to another investor about kind of emerging markets, and India came up. So let's take a look at this guy. It's HDFC. And I like that you're playing into India's growth, which is a growing emerging market. HDFC Bank Limited engages in the provision of banking financial services for individuals in India, Bahrain, Hong Kong, Dubai. Okay. They're in a good place, right? That region is growing very quickly. These guys are up 5%, they're up 7%. So this is a bank. Okay. So banks, banks, I don't value the free cash flow. I value with a different method. I look at book value and the growth of book value, and I look at earnings per share. So let's take a look. So banks make money by lending money out and having a interest spread. You lend money at a higher rate, you pay less than that. And then Trader Prad saying, isn't HDFC one of the most corrupt banks in the world? I don't know. But if there's, we'll look at some news there. Excuse me. We'll look at the news and see if maybe there's something to be considered there. So net interest growth is very, very fast. Okay. So net interest growth is higher. Revenue growth is through the roof. Very high growth. And, you know, maybe Trader Prad, I'd be totally interested in having like a live stream or if anything, like a podcast on India. I would be the learner in that equation or that situation because I don't know where to start with India. I know it's a very prosperous country where they're growing. I know that they have a very educated, I guess, workforce. And so I'd like to learn more about India. If you're game on that, I'd love to do that with you so I can understand and appreciate, you know, how to review an India company and be able to make a good investment. So these guys, I mean, on paper, it's looking like high growth. Okay, good. Okay. Now, when we look at the balance sheet, I'm going to look for book value. I think it's toward the bottom here. So here's the book value. And this is what, as I have read, and I look at investors that I respect, they base the value of a bank based on the growth of book value. And they have been growing their book value. So this looks very interesting. Their growth in book value is far faster than, let's say, I own Citigroup. Citigroup's been a good investment, but this is way faster in book value. And that is interesting. Okay, so book value looks great. And let's see what we have. No analyst covering this stock other than Trader Prad. Trader Prad's the one analyst that covers this stock. So the book value looks really good. Now, let's ask Meta. What is the fair price for HDFC stock? All right, Meta. It turned on its computers. It's flying around the world, and it's giving me currencies that I'm not familiar with. So price to earnings is 22. So these are rupees, and we'd have to convert that. So, okay, approximately, Meta, you are awesome. So $56 a share. And what's our stock price? What? No, that's the wrong one. Sorry. Ooh. So right now it's being priced at a premium, according to Meta. And the quick homework it did. So here's the price to book. Remember, I was talking about that. So Meta was smart enough to use price to book. Meta AI, man, it keeps doing stuff that I'm like, that's like a human being doing that. Maybe there is a human being behind Meta AI. So price to book is $8. So it's valuing the company way lower than its current stock price. You can't use discounted free cash flows, so I wouldn't use that. So average fair price is $49. So this one here, I love the question. I'm just not ready to give you a great analysis there because I'm new to India. I want to be sure I appreciate that. Like I've been investing in China for solid 5 years. Been doing some heavy analysis into Chinese companies. I have not done the same in India, but I'd like to. So I appreciate the question. I'm going to try to do some homework on India companies. This one seems like I like their growth, but I'd have to take it through a full valuation, which valuing banks takes a lot more time for me. And I'll probably do that. Maybe I'll take this bank, look at the peer companies, go with one, value it, maybe make a video. I think that would be interesting and worth doing. So I appreciate you bringing it up. That was HDFC. Okay. All right. We covered a lot of ground. Let's see what the market's doing. See if, geez, first day of October, September started like this. What the heck, stock market? If you remember a month ago, market's like selling off. It's like, what the heck, stock market? So it's selling off on the NASDAQ. The Russell's selling off. S&P's selling off. Dow is selling off. All right. So, well, we're just an hour into trading in the fourth quarter of 2024. So we're a couple runs behind. No problem. We can make it up. We got a good offense. And let's see how today plays out. But if stocks like Meta, like I was talking, Uber, Google, they sell off, I buy. No problem. No problem, stock market. I know the companies that I believe in. And if you want to discount them, I'm good with that. I'll buy more shares. All right. So Trader Prad, they had a big run on banks a few years ago. Banks, it's an interesting industry. We had a run on banks here in the US in 2023 when you had Silicon Valley Bank basically have a run on their bank. And banks have had such a interesting 100-year history where you've had runs on banks. Now, banks, you have to buy them at the right time, at the right price, and see that they're going to rise in value. Citigroup is the bank. I owned a couple banks when they were sold off in 2023. I bought Citigroup, U.S. Bank, Midwest Bank and Trust, I think. And they all won. They all made good returns. I sold two of the banks, kept Citigroup. And it's kind of just a hold because they pay a nice dividend and I'm good. But I took probably 2/3 of my capital out of banking. So in my opinion, you have to get into banks at the right time. They're not going to be compounders like a Meta or an Uber or even an NVIDIA where you just see appreciation, then appreciation, then appreciation. Banks will have an up and down, almost like a cyclical trend. Over time, they will become more valuable, but they're not going to have that really nice chart to the right. So that's my opinion on banks there. So, Mike, on sell-offs, you got to buy low, sell high. Yep. I agree. Perfect. So that is the live stream for today. Just a reminder, I'm going to live stream today at 5 p.m. Eastern. If you want to talk about the market, it might be an interesting day to talk because if this sell-off continues, it might be an interesting start to October, interesting start to the fourth quarter. And I'm going to review Nike. I'm going to go in detail. And I'm also going to stream tomorrow morning. So catch me at the same time, same place. And then I'm going to probably stream on Thursday at 5 p.m. again. I'm thinking Tuesday, Thursday might be the PM streams. Some of the community members have said, hey, when are you going to stream in the afternoon again? Because some people have to be at work. I totally get that. So I'll do it on Tuesday, Thursday, and hopefully that works for a lot of people. So it was fun today, everybody. I came into it, feeling the positive energy from September. Really nice appreciation. I closed the books. I did that earlier today. It was a very good month. I thank the universe. I thank the powers above the stock market for that type of return. And I'm ready to take October on and see where I can make good investments and hopefully see my portfolio go up in value. And I'm gonna be positive this month. Last month I came into it a little bit too negative, and it turned out to be really positive. So I don't know what to think now. I'm just gonna do analysis, find good companies, invest in them, hold them, and make lots of money. That's gonna be my plan. Everybody, thanks for tuning in. Really appreciate you all, and I hope you have a really nice day.